Or it could be that there's a major player in the market, like a central bank, who's quietly acquired a lot of futures in the past and now is surprising the market by taking delivery of more than usual futures instead of rolling them, and simultaneously, because it can't get delivery of all these bars in the spot month, is simultaneously buying more futures because they want to acquire. We got a lot faster than that now, and I think the chances of us getting to 3,000 are quite high. We're almost on top of it now. Got about $60, $70 to go. But when I said that, I think we were maybe a couple of hundred away from it, 2,600 at the start of the year. Well, let me start off by just showing to your viewers what commodity prices are doing. I'm looking here at the, it'll come on your screen in a second, at the CRB index. There you are. I think you could.
You're watching Silver News Daily. Subscribe for more.
Silver deliveries are exploding, 235% above previous records. Central banks are scrambling for gold like never before, and gold itself is on the verge of smashing through $3,000 an ounce. But what if I told you this isn't just a coincidence? What if these shocking moves are signs of something much bigger, a global financial event that could rewrite market history? Imagine a scenario where the world's financial giants are preparing for a collapse they won't warn you about. Silver deliveries detonating, COMEX turning into a physical cash market overnight, and central banks hoarding gold at record levels. This isn't just market volatility. It could be the start of a dollar-crushing inferno. What's really driving this panic? And how high could silver and gold go when the dust settles? Stick with me, because what you're about to hear might change the way you see the markets forever.
See that now. So what you see here is the Commodity Research Bureau. It's called the Thomson Reuters Core Commodity CRB Index. And it's showing the commodity index, the major commodities which are covered under the consumer price index at the end of the day. They have risen by 18% over the last year. There's quite a lag from commodities into the consumer prices, but it's only a question of time before that will affect consumer prices, and consumer prices will start to rise. What I'm going to show you on the next slide is the monthly inflation rates. That's the inflation rate for just 1 month, not for the full year. And you can see that the inflation rate was coming down from 0.5% right through to October until June. This is from January 23 through to October 24. We had a fall inflation when it actually went negative in the month of June 24. And then from July 24, we can see that inflation starts to rise. It's not in July, it's 0.2, August 0.2, September 0.2, or for the month, October 0.2, November 0.3, December 0.4, and January 0.5. That's inflation for the month. So what we have, looking at the next slide, is a trend now as core inflation starts to come off the bottom and rise, which means this hope of getting to 2% inflation isn't going to happen. Inflation rates are heading higher, and I think the market can see that, and it certainly makes people think about discussing, at least, inflation hedges. Now, you wanted to talk about what's going on in the gold market and gold prices. So I'll start off by showing you a very interesting chart. This chart, which we're looking at here, shows you the near-dated futures contract minus the spot price of gold. So the near-dated gold future minus the spot price of gold. So what happens when you have, so typically these futures contracts, they run for 2 months, and then they get to right down to the spot month, and the premium on the future gets to 0. So when we're 2 months away, normally the price of the futures reflects the spot price plus interest for 2 months. That's called the carry cost. And then every day it goes down a bit, down a bit, down a bit until spot equals the future. Then we have the new futures contract and it starts over again. So you can see these multiple triangle shapes. But if you look at the one where we get far right to the current contract, which happens to be the February contract, you can see the pattern is broken. There's something, it's all over the place. It's like very chaotic. It's all over the place. There is no normal pattern. And that means that something very strange.
The February silver contract has just sent shockwaves through the market, shattering previous records with a delivery surge 43% higher than anything we've seen before. And here's the kicker. There's still time left in the delivery window. Think about that. This isn't some slow, predictable climb. This is a rapid, almost desperate move that's raising eyebrows across the industry. Why the sudden rush? What's fueling this unprecedented appetite for physical silver? To put it into perspective, the last time we saw a delivery surge anywhere close to this was in December, when 45.8 million ounces changed hands, an event tied to the Russian invasion of Ukraine back in 2022. But even that pales in comparison to what's happening now. The February contract, historically an inactive month, has already become the largest inactive delivery month ever, with 4,370 contracts delivered and an entire week of trading still left on the clock. That's 43% higher than the previous record from January 2022. For an inactive month, this is unheard of. What does this tell us? It suggests that something far larger is brewing beneath the surface, something that's pushing big players to lock in physical silver at an accelerating pace. The usual patterns don't apply anymore. Demand is surging at levels that simply don't align with traditional market cycles. And when silver deliveries spike like this, it's often a sign that smart money is bracing for impact. But why now? And more importantly, what happens if this trend keeps accelerating?
Month, because people will be buying the spot month and selling the future month because they can't get the gold and they have no choice. But that's not happening. Something completely opposite of what we're expecting is happening. The futures month is going to a premium to the spot month over and above what we would expect. So we're seeing the futures month, the contango, as it's known, trading, instead of trading at, let's say, $2 or $3 over spot for the February delivery, and there's only a few days ago in February, we're seeing $10 or $15 over spot, giving rise to a potentially extremely high return for those who do have gold bars, could hold the spot in New York and sell the future. But why is the future? But that should normalize. Normally that's arbitraged away within minutes. Why is that consistently higher than it should be? Well, what that means is there's a player in the market somewhere who's not only taking delivery of the spot, he's also, whoever it is, we don't know, buying the futures and pushing the futures up to an unreasonable premium over and above the spot, which makes no sense. So it might become clear down the line what's happening. It could be people who are in the know saying, hey, there's a lot of shorts out there. They can't get their hands on the gold. We're going to squeeze them and we're going to buy spot and buy future, push the price of gold up and up to make them pay. It could be that going on. Or it could be that there's a major player in the market, like a central bank, who's quietly acquired a lot of futures in the past and now is surprising the market by taking delivery of more than usual futures instead of rolling them. And simultaneously, because it can't get delivery of all these bars in the spot month, is simultaneously buying more futures because they want to acquire a lot of gold in a hurry.
With February's silver surge setting new records, all eyes are now locked on the pivotal March contract, and things are heating up fast. There are just 6 days left until first notice day, and the March contract is running hotter than anyone expected. But why is this particular contract so important? Because March isn't just another month. It's a major delivery period that often sets the tone for silver's market direction. And right now, the signals couldn't be clearer. Demand is accelerating at a pace that suggests something big is coming. Let's break this down. The lead up to first notice day is always telling. It's when traders must decide whether they're serious about taking delivery of the physical metal or just playing the paper game. But here's the twist. This time, buyers aren't backing down. The March contract is seeing sustained time demand, and with the clock ticking, the pressure is building. 6 days might not sound like much, but in the world of commodities trading, that's an eternity. Especially when market participants are scrambling to secure metal in a tightening supply environment. Why the urgency? It could be linked to growing fears about physical availability. The February surge wasn't a one-off. It was a warning shot. If the March contract follows a similar trajectory, We're looking at a scenario where back-to-back delivery surges signal a structural shift in the silver market. It's not just about speculative trading anymore. This is about securing real, physical assets. And when major delivery months like March start running hot, it often points to underlying stress in the system. A stress that could trigger sharp price movements if supply can't keep up. But what happens if March surpasses February's record-breaking pace? Could we be witnessing the early stages of a silver squeeze? The countdown has begun, and the next 6 days could reveal everything. Are institutional players hedging against a looming financial event? Or is this the smart money preparing for silver's next explosive move?
Is going on in the futures market. And we can see a little bit what's going on if I look at the next slide, which shows you the number of delivery notices per month, going back all the way back to December last year, December 23, that is. Very few contracts, gold futures contracts, actually get to be delivered because usually they get closed out, the buyers and the sellers close their contract and then they roll it into a future month. And we have major delivery months and minor delivery months. We'll ignore the minor delivery months, which aren't so important, but the major delivery months run February, April, June, August, October, December, and back to February. Now, if you look at this chart, you can see that month after month, we typically never have mostly we don't have more than 30,000 contracts delivered, or delivery notices as they call them. The highest was in June when it was 30,000. But go back a year ago to February 2024, there were 20,000 delivery notices. This February, a year later, there's more than 3 times as many. There's 70, so far, and the month's not over yet, there's 73,624 delivery notices, basically meaning a lot of people are taking the gold out of COMEX rather than rolling the contract into a futures month. So the question, which I don't have an absolute answer for, but we'll play with that a little bit, is why are people taking delivery of their gold at the moment? What's going on here? So I'll just look a little bit at the next slide with the actual numbers. On the left-hand side, you can see the actual hard numbers for the COMEX gold delivery, and you can see it's up 255% as of yesterday, and the silver delivery is 235% higher than usual.
Now here's where things get truly unusual. The February silver contract didn't just break records, it shattered expectations in a way that defies typical market behavior. Over 56% of the delivered metal came from contracts created after first notice day. Let that sink in. More than half of the silver delivered wasn't even part of the initial lineup. This is a major deviation from the norm, so typically deliveries post first notice day are minimal, almost an afterthought. But this time, it's become the main event. And that tells us one thing: urgency. But why would traders pile into new contracts after the delivery window had technically opened? The answer is simple: panic, opportunity, or maybe a bit of both. If traders are rushing to secure physical silver after first notice day, it suggests that something triggered a sudden surge in demand. Were they caught off guard by tightening supply? Or did a key market signal convince them that silver's price was about to run higher, forcing them to lock in deliveries at any cost? This kind of post-FND activity is rare and speaks volumes. It indicates a scramble for physical metal, an environment where buyers no longer trust paper promises. In typical delivery cycles, post-FND activity barely registers, but now it's the headline. The sheer volume of these late-stage deliveries is rewriting the rules. It's as if traders woke up overnight, realizing that paper contracts won't cut it anymore. They want the real thing, and they want it now. Could this sudden rush signal a deeper liquidity issue in the silver market? Or is it a strategic move by institutional players, seizing control of physical assets before an anticipated price breakout? Either way, the silver market isn't behaving as it normally would. And when markets deviate from their usual patterns, it often means that a major shift is on the horizon. So the question remains: what forced this hand? What caused traders to abandon the safety of standard timelines and dive headfirst into physical silver, even after the clock had started ticking? Something big is brewing, and it's only getting harder to ignore.
there, talk about what's going on in London. A lot of the gold dealers, and these would be companies, hedge funds, banks, and others who play the COMEX market, would normally go short the future. So 2 months out, 3 months, they're shorted. But they're fully covered because they hold gold, or at least some of the gold, in London. Why do they hold in London? Because that's a great place to hold your gold and lease it out. And the people who've shorted gold actually have no worries in normal times because they think, we'll get to the current month and I'll just roll it over into the future month and nobody will ever ask for delivery. It never happens, or almost never happens, except it is happening this time. But they've got the gold in London, so the normal way of thinking is, well, if I have to deliver, I'll just ship the gold from London, convert the 400-ounce bars into 100-ounce bars, and within 2 days, I'll be able to deliver the gold in New York. Except there's a hiccup. The Bank of England and the LBMA are facing a large number of requests for delivery of gold bars to New York, and there's a large backlog. The backlog could be somewhere in the region of 4 to 8 weeks now, which means that those people who are short on New York, they may be fully covered because they got the gold, but the problem is it's not in the right shape or size, it's not 100-gram bars, and it's not in New York, it's in London. They can't get it to New York in time. So what are they being forced to do? They're being forced to buy back the contract that they shorted and roll it out for a future event, a future date, by shorting the future. Now, normally when that happens, you'd think that the contango would go to a backwardation. In other words, an unusual situation. You'd think the spot month would be higher than the future.
COMEX has flipped the script. Traditionally known as a paper trading hub where futures contracts are settled in cash, it's now transforming into a physical cash market. What does that mean? It means traders aren't just speculating anymore. They're demanding the metal in hand, and they're demanding it fast. This isn't some minor technical shift. It's a fundamental change that signals deep-seated concerns about counterparty risks and the reliability of paper promises. For years, COMEX operated as a platform where most contracts were closed out before delivery. Cash was king. But now, record-high transactions during the delivery period show a market rushing to secure physical silver and gold. Traders are no longer comfortable with just exposure. They want the real deal right now. The message is clear. Trust in the paper market is eroding, and the rush for physical metal suggests that something big is pushing them to secure tangible assets. But what's driving the shift? One major factor could be the fear of liquidity drying up. When confidence in the system starts to waver, the last thing anyone wants is to be left holding a paper contract backed by empty promises. Physical metal becomes the ultimate insurance policy, a hedge against not just inflation, but systemic risk. And right now, that insurance is being snapped up at record pace, and the timing couldn't be more telling. As COMEX morphs into a physical delivery hub, it raises a critical question. Is this the first sign of a larger liquidity crisis? If institutional players believe that future deliveries might not be guaranteed, it would explain the scramble we're seeing. They're locking in metal today because they're unsure it'll be available tomorrow. And when that fear spreads, it can turn into a self-fulfilling prophecy, a run on silver that pushes prices into uncharted territory. This transformation of COMEX isn't happening in a vacuum. It's part of a broader pattern. Central banks hoarding gold, record ETF inflows, and now silver deliveries detonating past all historical norms. The silver market is sending a clear signal. Something is shifting, and fast. The question is, are we witnessing a temporary market anomaly, or is this the beginning of a new era where physical silver reigns supreme?
But the gold price is still going up, which definitely tells me that there's something bigger afoot than retail investors. Retail investors are not in the market, they're sellers. And that, whoever's in the market, I believe it most likely is central banks. I mean, there could be some big players, but I think it's not the man in the street yet. We don't have the mania that we have in the Mag 7, where every Tom, Dick, and Harry is talking to his friends over dinner about how much money he made in NVIDIA. No, you don't go to dinner parties and hear someone say, hey, I bought some gold 2 weeks ago and look, it's up $10. That's not happening. But you are hearing, you've still got people talking about how clever they were to buy the technology stocks. That's the conversation for those who are talking about investments. They're talking about either Bitcoin or they're talking about the Mag 7. So I don't think gold is in the conversation for the man in the street yet. I think it will be. We're a long way from that, or we're some way from that. But I think it's coming because the gold price itself is starting to rise. But what I'd like to do, if I may, is show you another slide which shows you roughly where we are in the gold cycle.
So, who exactly is behind this surge in silver demand? The answer might surprise you. Silver demand can be broken down into 4 key tiers. First, the bullion banks. Second, customer accounts holding the large 5,000 Oz contracts. Third, smaller 1,000 Oz contract holders. And lastly, retail investors. But right now, all the action, all the smart money is concentrated in just one place, the 5,000 Oz contracts. That's where the big players are placing their bets. And the rest of the market? Strangely quiet. Retail demand, usually a good indicator of broader market interest, remains subdued. Even the micro silver contracts, the 1,000 Oz variety popular among smaller institutions, are seeing a slowdown. And retail proxies like PSLV, Sprott's Physical Trust, barely moving. This is the exact opposite of what we saw during the silver squeeze, where retail demand went through the roof. So why are the largest customer accounts, the so-called smart money, loading up now, while retail investors remain asleep? The likely answer? Information advantage. Institutional players often move ahead of retail investors because they have better access to information, deeper market insights, and the ability to influence price movements. If the biggest players are stacking silver while retail sits on the sidelines, it raises an urgent question. What do they know that the rest of the market doesn't? Perhaps they see what others don't, the fragility in the physical silver supply chain, or the growing stress in the financial system. Maybe they're betting on a silver breakout triggered by macroeconomic factors like looming recession fears, rate cuts, and collapsing confidence in fiat currencies. Or perhaps they anticipate a short squeeze, where silver's artificially low price can't hold much longer under real market pressure. One thing is clear. When the smart money makes a move, it's rarely without reason. Their focus on the 5,000 Oz contracts, while bypassing smaller options and retail plays, signals a strategic accumulation. This isn't speculation, this is preparation. They're securing large volumes of physical silver now, likely expecting conditions that will make future access harder, pricier, or both. And if history has taught us anything, it's that retail investors often realize the opportunity too late, after the price has already run. So the question remains, are these institutional players preparing for a silver surge that retail investors will miss? Or is this accumulation the first step toward triggering the breakout themselves?
You want to jump on a racing, on a moving train before it gets away from you.
The market usually
and I
follows.
think, that to a very small extent, I think some investment managers are starting to look at whether they should have a little bit of gold in the portfolios. I've been in Switzerland for 40-odd years. When I first arrived in Switzerland, we traditionally had 5% gold in every portfolio. That's discretionary portfolio. By the time we got to the about 2000, from about 2000 to 2010 or thereabouts, the gold price was the 2010 through to 2020-ish. The gold price went nowhere in that decade. So little by little, the gold started to vanish from the portfolios. Our asset allocators, that the people who tell you as an investment manager how much gold you should have in a portfolio, they started to say, we want more in equities, we want more in hedge funds, we want more in customized products, we want more in this and that and the other. Where should we take it from? Oh, we'll take it from the gold. Gold's doing nothing. So little by little, that gold exposure went down to zero. Now, in Switzerland, it's started to go back up again. Some banks have even put gold as their most preferred asset already. Most preferred means they'll have 3% or 5%. Some banks haven't done that yet. I don't know how it is in the rest of the world, but I think there's going to be, with the rise in gold price, people will be inserting gold as an experiment into specimen portfolios, back testing and working out that the Sharpe ratio, that's a ratio which measures risk and reward, gets improved by a little bit of gold in the portfolio. So I think as they do this maths, they will start to say, it now makes sense to have gold in the portfolio. So I think that could be just starting, but it's got a long way to go.
While silver demand is quietly surging among institutional players, something even more revealing is happening in the gold market. Central banks, those who control the levers of the global financial system, are buying gold at a pace not seen in years. Over 1,000 tons of gold purchased for the third consecutive year, with some central banks ramping up buying by over 50% in just the last quarter. Poland alone has added 90 tons to its reserves. But the big question is, why now? What are central banks preparing for? The timing couldn't be more suspicious. Gold is flirting with an all-time high of $2,956, and yet central banks are still buying aggressively. Historically, central banks accumulate gold when they see economic instability on the horizon, whether it's currency devaluation, geopolitical risks, or a breakdown in the global financial system. This isn't just portfolio diversification, this is a defensive move. What's even more interesting is that their gold buying spree is happening alongside the record-breaking surge in silver deliveries. Could these two events be connected? Central banks are known for playing the long game. They don't panic buy assets unless they foresee systemic risks. If they believe the dollar's dominance is weakening, or that fiat currencies in general are losing credibility, gold becomes the ultimate hedge. And when central banks panic, it's often the smartest warning signal for the rest of the market. But there's a silver twist here. Historically, when gold prices surge due to central bank buying, silver follows, with far more explosive gains. Silver is often referred to as gold's shadow, but when it moves, it does so faster and harder. The current disconnect, gold nearing $3,000 while silver lags, might be the biggest opportunity of all. Central banks may not be directly buying silver, but their gold panic could be setting the stage for silver's most aggressive rally yet. Consider this: if central banks are hedging against a dollar crisis, inflation shock, or liquidity freeze, gold's rise past $3,000 is inevitable. And when that happens, silver doesn't just follow, it plays catch-up with a vengeance. Every historical gold run has seen silver outperform in percentage gains. The silver market is smaller and more volatile, meaning even minor shifts in institutional interest can cause massive price spikes. So, are central banks indirectly triggering the next silver supercycle? Their gold panic might be the final piece of the puzzle, because when the institutions that print money start hoarding hard assets, you can be sure that the era of cheap silver is coming to an end.
Well, of course, we've had Mr. Trump's election, and he's seen as a bit of a wild card. You don't know what he's going to do tomorrow. So that has increased the level of uncertainty, not only for investors generally, but also for central banks. They don't know what, when he opens his mouth tomorrow, what might happen. Maybe one of the catalysts for the rise in gold prices in New York over and above elsewhere was the threat of tariffs. Now, there's no reason why he would need to put tariffs on gold. I mean, the U.S. gold mining industry isn't being dumped on. China or there's no country in the world shipping their gold to America at half price and dumping on America. I mean, they may be shipping their cars or their iPhones or their electronic goods and dumping that way, or their steel, who knows. But there's no way they're dumping gold, because the gold gets sold in the United States at exactly the same price as every other country. So there's no industry in the United States which needs to be protected. If they were to stop gold imports or put tariffs on gold imports, first of all, those countries that have got gold to sell would sell it somewhere else. It's easy to sell everywhere. And secondly, it wouldn't help the American gold mining industry, because they're not going to suddenly start opening a ton of new mines. And even if they do, it take decades for that to come on stream. It's not a necessary new industry which needs to be protected. There really is no need to protect America or Americans from foreign gold miners. So I don't think there's a reason to put a tariff on gold unless they just want to raise revenue for the American government. That's another story. But that could have been the fear that tariffs would come in might have been one of the reasons why, which sparked off this initial flurry of gold buying. And then once the flurry starts, it can become self-fulfilling because people say, okay, they might not put tariffs on, but the price is rising. I better get some because you want to jump.
Gold is knocking on the door of a historic milestone, $3,000 an ounce. After touching an all-time high of $2,956, it briefly pulled back, but the momentum remains undeniable. 8 consecutive weeks of gains, the best streak since 2020, and all the technical indicators suggest that bulls still have the upper hand. But why does this $3,000 level matter so much? Because it's not just a number, it's a psychological barrier. A point where market sentiment could flip overnight, sending both gold and silver into a frenzied rally. Technical analysts believe that breaking $3,000 would ignite a wave of momentum buying, drawing in retail investors, hedge funds, and institutional players alike. The 23.6% Fibonacci retracement level sits at 2,856, already tested. The 30-day SMA at $2,832 has proven resilient. And despite mild selling pressure, the RSI and MACD indicators show that gold's upward momentum remains intact. A push past 3,000 could signal the start of a new bull phase, one driven by panic, momentum, and fear of missing out. But here's where silver comes into the picture. Historically, silver lags behind gold in the early stages of a rally. But once gold crosses key psychological thresholds, silver doesn't just follow. It explodes. The gold-to-silver ratio is currently at levels that have historically preceded silver breakouts. If gold moves decisively past $3,000, silver could surge at a pace that leaves investors stunned. We're talking about silver potentially playing catch-up with triple-digit percentage gains in a matter of months. This isn't just speculation. The setup is right in front of us. Gold's rally is being fueled by safe haven demand as recession fears mount. Central banks hoard gold, and the dollar's strength wanes. Every one of these macroeconomic drivers has historically pushed silver even higher once the breakout begins. And with silver's relatively small market size, it wouldn't take much to trigger a supply crunch that sends prices soaring. So what happens when gold breaks $3,000? It becomes a global headline, drawing new money into the metals market. But silver? Silver becomes the trade of the decade, the asset that outpaces gold's gains, driven by a perfect storm of industrial demand, supply constraints, and investor FOMO. The race to $3,000 gold is nearing its climax, but the silver story? That's only just beginning.
Well, I've read that speculation too. That could be that they're trying to replace the bars which have been lent out or stolen or which aren't real or who knows what. It's a possibility. Or it could be another central bank or central banks trying to acquire a position before it becomes apparent that they are in a hurry. Now, last year, there was something like 27 central banks acquired gold. They increased their gold holdings. And when you look down the list, with the exception of one, which is Poland, none of those central banks are the best friends with the USA. So over the last year or two, we've seen the United States weaponize the dollar, basically saying your bank balances are frozen. And not only that, we're going to pay your bank balances to your enemy. So when you weaponize somebody's dollars, it makes those people who are not the best friends with the United States think, well, do I really want to hold all these dollars? We haven't done anything wrong yet, but who knows how we're going to feel in a year or two. We have to have a plan B. And there could be a generalized move. I think, well, there is a generalized move by many central banks now to start acquiring some gold at the expense of treasuries. And, we see that in particular with China, where over the last year or two, 85% of the increase of China's reserves has been represented by the rise in the value of their gold holdings through two things. One, they've been purchasing gold, and that's been ongoing. And secondly, the price of gold has been rising. But they continue to buy despite the gold price being at an all-time record. So, reading between the lines, they don't really care what the gold price is, record or not record, they want more of it. So even though almost all of the increase in their reserves is represented by gold, they still want more because the amount of gold they hold per citizen is very small compared with that of the United States. So it could well be a central buyer trying to hurry up, a central bank buyer, like China, for example, trying to hurry up and buy gold. But of course, the question would be, why would they buy in New York when they can buy in London? Well, perhaps they're buying in London too. We don't know. I suppose when you're in a hurry, you buy wherever you can get it.
As gold edges closer to the $3,000 milestone, recession fears are adding fuel to the fire. The market narrative has shifted dramatically. What started as optimism for pro-growth policies has turned into widespread concern that the new U.S. administration's aggressive cost-cutting initiatives may actually be triggering real economic damage. The latest services PMI data shocked investors, pushing the Citi Economic Surprise Index to its most negative level since September 2024. The result? Treasury yields have plummeted, with the 10-year yield falling to its lowest point in over 2 months at 4.34%. Why does this matter? Because falling yields are a signal that investors expect rate cuts, and soon. Swap markets are now pricing in 53 basis points of rate cuts for 2025, a full 2 months earlier than previously anticipated. The Treasury's auction of 2-year notes drew record demand, showing that investors are positioning themselves for lower rates and potential economic turbulence. And when recession fears take center stage, precious metals, especially gold and silver, become the go-to safe haven assets. But silver's story in this context is even more compelling. While gold benefits immediately from safe haven demand, silver's gains often lag, until recession fears become recession realities. Silver isn't just a monetary metal, it's also an industrial powerhouse. In a typical recession, industrial demand would slow, but this time it's different. Green energy transitions, electric vehicles, and 5G infrastructure are driving silver demand higher, regardless of economic conditions. This unique combination of monetary and industrial demand makes silver the standout performer when economic uncertainty peaks. And here's where things get interesting. If the Federal Reserve cuts rates earlier than expected, the dollar will weaken further, making silver and gold even more attractive. The last time we saw a similar setup, low yields, recession fears, and bullish technicals, silver surged over 400% in less than 2 years. The conditions are eerily similar today. The market is teetering on the edge of a shift from monetary tightening to easing, and when that pivot happens, silver could explode as investors rush into hard assets. Recession fears are no longer just whispers, they're becoming the dominant market narrative. And as history shows, when gold leads the way during times of uncertainty, silver follows, but with far greater intensity. The countdown to $3,000 gold may be dominating headlines, but make no mistake, the real story, the one with explosive potential, is silver's long overdue breakout. And with recession fears mounting, that breakout
but they've
might
got a
be
long way,
closer
even though they're
than
outperforming
anyone
this year.
expects.
By historical standards, they've got a long way to go. And I've done a bit of a study on a few of them, Barrick Gold, Newmont, and more recently, Harmony Gold in South Africa. The analysts are underestimating at the moment the increase in earnings per share that we're going to see in the current year and next year. And that's based on the fact that most of these gold mining companies have hedged part of their portfolio, typically 50% of their portfolio or their gold, they hedged it for the future. They've got, they sold it forward, and or they've got caps and collars, which limit their upside, but also limit their downside. And half they tend to let run and get exposed to the full blast of the gold mining market. But based on everything that can be known, the gold they're selling this year will be being sold for a substantially higher price than last year. And their costs have not increased by so much. The net result of that is we can expect to see profits of many gold mining companies increasing in the current year by more than 100%, and sometimes by several 100%. And because of the lagged effect due to the hedging, that will happen, and assuming we stay at 2,900 for the gold price, that will be happening again next year, another 100 or 200 or 300% increase in the profits on this year's Greek result. Now, when you look at the forecast from the analysts, yes, they are showing substantial increases in the expected profits. And every month or two which goes by, you see that forecast being increased. So each analyst goes a little bit higher than the other, but they all stay within the pack. The pack's there, and the one at the bottom moves level to the top than the one at the bottom. So they're piling on top of each other, raising the forecast. But the actual number which will come out is up here, and it'll take some time before the analyst forecasts reach the likely outcome. So to my mind, gold mining stocks are, if they're reflecting what the analysts are forecasting, they're underestimating what will actually happen. And the ones I looked at are fairly cheap. The one I looked at today, Harmony Gold, is on a P ratio of about 7, and that's going to drop to about 4, based on the price of gold rising. Now, that's not a recommendation to buy any particular stock, but I'm saying as a generality, the sector is a very cheap sector compared with the rest of the market, the gold mining sector, and I think the same would apply to the silver mining sector. It's relatively cheap compared with other stocks you can buy. It's worth a look, and it's a very small sector of the market. So if and when even a little bit of money starts to find its way into that sector, it can really take off, as we are seeing already happening with the sector now being up 20-something% compared with gold up about 13%. So it looks like it's starting, but it's got a long way to go if that continues. But my personal view is, one, we're seeing some movement into the sector now, and I think that can only accelerate as people start to realize that, one, the multiples are low, and two, those forecasts being made by the analysts are constantly being increased.
While recession fears and gold's charge toward $3,000 dominate the headlines, there's another surge happening quietly, but with potentially explosive consequences. Exchange-traded funds, ETFs, backed by physical gold have seen their largest net inflows since 2022. Institutional money is pouring into bullion-backed ETFs, signaling renewed confidence in physical assets over paper promises. ANZ Banking Group analysts have noted a discernible increase in physical flows, adding even more technical support to gold's climb. But the real shock is coming from COMEX. Since late November, COMEX-approved warehouses have seen physical gold inventories surge by an astonishing 73.5%, hitting levels not seen since July 2022. Why? Traders are increasingly opting for physical delivery rather than settling contracts in cash. This trend suggests rising concerns about counterparty risks and the reliability of paper gold, and the fear of Trump's tariff threats extending to precious metals has only intensified the rush to secure physical assets before prices potentially spike. Here's where silver enters the spotlight. While the gold hoarding on COMEX might seem like a separate phenomenon, it's actually a crucial part of the silver story. COMEX, turning into a physical delivery hub for gold, sets a precedent. When faith in paper markets breaks for one metal, it can quickly break for another. Silver's much smaller market size makes it even more vulnerable to rapid price movements. If a similar rush for physical silver begins, the price could skyrocket with far less buying pressure than gold requires. And the timing couldn't be more critical. Physical gold prices in Asia, especially in India, are now trading at a discount to futures due to weak retail demand, signaling supply disruptions. At the same time, jewelry companies are feeling the pinch as gold lease rates tighten, hinting at a growing scarcity in the physical market. If gold continues its rally, silver's role as the poor man's gold will become more pronounced, pulling in retail investors looking for exposure at a lower price point and potentially triggering a massive silver squeeze. So what's next? With ETF inflows accelerating, COMEX inventories rising, and physical delivery becoming the preferred settlement method, the stage is set. Silver's supply constraints, combined with increasing institutional interest, create the perfect storm for a price explosion. Gold may be nearing $3,000, but silver's rally is just getting started. The question isn't if silver will break out, it's when and how violently it will move when the floodgates finally open.
Not at all. And I think the other thing, which is perhaps worth saying, is gold miners. Gold miners, as a collection, still remain very significantly below the peaks seen a few years ago. And I'll just show you a chart, a long-term chart on that, where you can see, let's go back to screen, share. Now, what you're looking at here is going back to 2008, the performance of the two ETFs called GDX and GDXJ. That's the gold mining ETF of the major companies, GDX, and the gold mining ETF of the juniors, GDXJ. It's all in percentage terms from 2008, compared with the gold price at the top in red. Now you can see that since 2008, the gold price is up nearly 300%. It's about 200. It's more than 275%. Whereas the GDX and the GDXJ, which are the gold mining indices, are still in negative territory. They're below where they were in 2008, despite the fact the gold price is nearly triple what it was. So, for example, the GDXJ is down 50% from 2008, and the GDX looks like it's down about 10, 12% since 2008. So, relatively speaking, we're not seeing any participation in the gold shares market, except maybe we are, because now I'm going to turn to the current year, 2025, and you can see that in the current year, whilst gold is heading higher, and it's up about 12, 13% now, you can see that GDX and GDXJ has started, at least in the current year, to outperform gold. We've been waiting for years and years for this to happen. And at last, now we've got the GDXJ up about 23% and the GDX up about 25%, compared with gold up about 12, 13%. So at long last, for those who've been, I suppose, very disappointed with gold mining shares, we're starting to see a degree of outperformance in these mining stocks.
This is it. The moment where all the pieces come together. Silver deliveries have detonated 235% above record levels, with February's surge obliterating previous highs in March poised to follow. COMEX isn't just a futures playground anymore. It's turning into a physical cash market. Traders aren't playing games. They want real metal, and they want it now. Central banks are in a full-blown gold panic, hoarding over 1,000 tons annually as gold teases the $3,000 mark. The smartest money in the world is preparing for something. The question is, are you? Because this isn't just about silver or gold, it's about what these moves signal. A potential global financial event that could rewrite everything we thought we knew about precious metals. When central banks, institutional investors, and big players start hoarding physical assets, it's not random, it's strategic. They see what's coming: a weakening dollar, a slowing economy, a system under stress. And history tells us that when gold breaks through psychological barriers like $3,000, silver doesn't just follow, it explodes. With silver still trading at a fraction of its historical peak, the upside potential is staggering. The pieces are in place: recession fears pushing investors to safe havens, falling treasury yields signaling rate cuts, and physical demand overwhelming COMEX's paper markets. The silver squeeze that retail investors dreamed of could be triggered by the institutions themselves. And when silver runs, it runs hard. It lags behind gold at first, but when it catches up, it slingshots past expectations, sometimes by hundreds of percentage points. Could $100 silver be on the horizon? With this setup, it's not just possible, it's plausible. But here's the bottom line. The window to act is closing fast. Smart money has already made its move. The mainstream media won't warn you, and by the time the headlines hit, the opportunity will be gone. If silver breaks through key resistance levels, the breakout could be historic, and those who position themselves early will reap the biggest rewards. So, what do you think? How high could silver go in this dollar-crushing inferno? Let us know in the comments. And if you want to stay ahead of the financial reset, make sure to subscribe to the channel. Silver's time is coming, and those who prepare now will be the ones who benefit the most. But remember, this isn't financial advice. Always speak to a qualified professional before making any financial decisions.
This is the gold price year by year going all the way back to 1970 from January through to December. And on the far left-hand side, this is all in percentage terms, by the way. On the far left-hand side, you see in dark blue, where I'm moving my mouse, I think you can see that, the price of gold this year in percentage terms. As you can see, although it's towards the top of the pack, it's by no means the highest ever performance. It's well within the realms of normality, historically, going back over the years. So there are plenty of years, historically, when gold did something similar to what we're seeing this year. One can hardly say that it's the best performance ever, at least not since the 1st of January. So if you look at the way the gold price has developed over the years, you can see that we could still, if we just stay within the pack of what's happened year by year, we could still see the gold price appreciating substantially for the rest of this year. I was earlier this year saying, back in January, saying I think we'll hit 3,000. Well, it's kind of